Hello, everybody, and welcome to 2025, and welcome to our first webinar of 2025. My name's Richard Madden. I am the Executive Chairman of Europe for DC Advisory, and I'm joined in this conversation by my colleagues Bill Core.
Hello, everybody, and Richard, thank you very much. My name is Bill Core. I'm CEO of DC Advisory in the U.S. Pleasure to talk today.
And I'm joined by Tosh Kojima.
Hi, everyone. I'm Tosh Kojima, Managing Director based in London, and I head up a unique team called Asia Access at DC worldwide. We have a dedicated team of Asian bankers in Europe and in the US, and together with our M&A teams across 10 Asian, 4 US, and 10 European offices, we deliver Asian buyers and investors to European and US businesses, which we have successfully done over 200 times in the last 10 plus years. Nice to be here.
Tosh, thank you very much. Well, 2024 was a challenging year from an economic standpoint. There was significant electoral uncertainty, and there was, of course, continuing conflict, which all ate into confidence and led to a further downturn in M&A, down 4% last year compared to the 24% drop of the year before. But we do feel more positive about levels of activity in 2025. And I'm delighted that Sveta Gopinath is going to join us to host our conversation about 2024 and 2025. Sveta.
Thanks, Richard. I'm Sveta. I cover private equity and M&A here at Bloomberg. Looking forward to what I'm sure will be a very interesting conversation.
Thank you. Over to you.
Okay, great. Yeah. Richard, you said we're likely to see a busier 2025. Are you seeing any early indications yet of a pickup in deal activity?
No. Deal activity takes a very long time, because if you think about an M&A transaction, it broadly takes anywhere between, at the very short end, 6 months, but more likely a year. And in the current markets where confidence is low, it is much more likely to be a year than less. So even if people were feeling positive now or wanting to transact now, it's unlikely that we would see that in any deal announcements.
Announcements aside, are you seeing RFPs coming in? Do you expect to get more deal advisory mandates? Are there any indications at all to say that this year will be an improvement over the last? I know it's we're only sort of 10 days into the new year, and it may be a bit early yet. But looking forward to the coming weeks, what do you expect to see?
You're right that it's early, but there has certainly been a much more active conversation. But the conversation isn't really driven by a fundamental belief that the world is going to be a better place. It's driven much more by the fact that people feel they will need to transact. Bill, I don't know if that's what you're seeing in the US.
Yes, Richard, I would agree with you. It's been the last 3 years have been a very interesting time, and we're beginning to see an uptick in dialogue and transaction activity. So we're seeing a lot of those same trends.
Yeah.
Okay, yeah. When can we expect deal activity to meaningfully pick up? Richard, as you were saying, there's a long lead time to actually get deals done. So is this likely to be more of a 2026 event then, a meaningful pickup in M&A?
Yes. But by the time we see real acceleration, it will be 2026. I think it's quite important, though, to unpick why it is that we might see acceleration. And I think that is a different picture between Europe, Asia, and the US.
Should we start with the US then, which is likely to be the busiest market, I suppose? What are the deal drivers you're seeing there?
That's a very interesting question and very topical. And as I'd make 2 points. The first is I think some of the key drivers that were impacting the M&A depression we've been in the U.S. in the last 3 years were what I call the 5 big uglies, which are inflation concerns, rising interest rates, political uncertainty, stock market volatility, and we had 2 wars. And some people might say it was more than 2 wars. And as those things begin to abate, not all of them, but the pressure from any one of them is beginning to cause more activity, and interest rates have moderated. Political uncertainty has not been completely resolved, but we now know the outcome of the U.S. election. We'll see what happens with peace negotiations both in Ukraine and in the Middle East. And the stock market, at least in the U.S. since the election, has risen fairly materially here in the short run. It's come back a little bit, but those dynamics and those pressures have begun to abate a little bit, which is beginning to cause some of the drivers of the slowdown to begin to ease, and people are becoming more and more interested in transacting.
The geopolitical events you mentioned, the wars in particular, are at least geographically closer to Europe. So what does it mean for activity in Europe, Richard?
Sveta, I think it's hard to see that there'll be any fundamentally strong economic stimulus in Europe to drive a renewed confidence. Because if you look at the major economies, the UK is at threat of stagflation. France doesn't really have a government. Germany is about to have an election. And it is hard to see where an engine of future growth comes from. So I think we're going to have to look beyond that for our particular stimulus. And I think that stimulus is going to be driven not by a fundamentally changed view of economic activity, but actually by the way that private equity is set up. Because private equity has been put on earth to do three things: to invest in businesses, to improve those businesses, and then to sell them. And not only have they been put on earth to do it, they've been given a specific timetable to do it in, i.e. the timetable is the fund life cycle. Because they haven't been divesting, they are years behind, probably 3 to 4 years behind their divestment schedule. Now that feels fairly scary, and it's beginning to feel fairly scary for their investors. Their investors want some money back. They want some liquidity. And so the pressure on private equity will increase so that they have to put businesses up for sale, even if they don't think they'll get the price that they once hoped they might.
Okay. Yeah, I mean, I think we've been hearing about sort of a valuation gap between buyers and sellers for much of the past 18 months. Do you see that bridge between the two parties being met to an extent if private equity becomes a bit more desperate, I guess, to monetize assets?
Yes, I mean, it's particularly interesting, isn't it? Because private equity are the people who say that when they own it, it's worth a fortune, and when they're buying it, it's not. So it's the same people having a different perspective depending on which hat they're wearing. I do think that there will be compulsion in the system, and therefore they'll have to accept the best price that they get rather than the price they once hoped for. Now, there's still evidence of transactions failing, transactions being pulled because they haven't reached a reserve price. It was all over the press this weekend that BPP process has been pulled. So there is some of that around, but there has to be an acceptance that valuations are not what they once were. The challenge to that, of course, is that the public markets, as Bill mentioned, are doing so fabulously well that people think fabulous valuations might well be achievable. And for as long as they believe that, then we will have a valuation gap.
Could more private equity sellers be persuaded to IPO assets, perhaps, if public market valuations continue to overtake private market valuations?
Yeah, I mean, I think in the US, Bill, I don't know what you think, but I think that feels a pretty likely outcome.
It certainly does, Richard, and it's a very important question, Swetha, and I think you have to almost bifurcate the thought process between kind of transaction activity and size of transactions. In the middle market, as an example, depending on how you define middle market, an IPO exit may be an alternative, but there are some limitations, particularly in the U.S. from a size constraint in terms of having that as a viable and attractive exit alternative, and generally for investments which are larger, I would say. But that does leave a gap, particularly in the middle market, where this phenomenon needs to resolve itself. And I think it will.
Yeah. Tosh, how about Asia? Do you expect to see more active private equity sellers there?
Oh, absolutely. So, well, first of all, when you say Asia, you really have to separate Japan and then China related and more of a sovereign wealth fund and other related Singapore market, because three are very different in its maturity curve, etc. I'm going to talk about Japan, and just touching on an IPO point you just mentioned. Japan is going to a different opposite trend, because in Japan, to IPO a company far smaller than it would be allowed to do so on London or New York Stock Exchange, maybe exception of Nasdaq, would have been very, very easy. And what has resulted over the last 10, 20 years is too many sort of Japanese publicly listed companies with very low liquidity, very low sort of investor and analyst interest, sort of stagnating and becoming sort of zombie. Now, it did manage to cash out the founders very well, but it's not really going anywhere, which is actually providing a very fertile ground for consolidation and private equity activities. On the question of private equity exit, Japan has trailed in the evolution of private equity market behind Europe and, of course, certainly behind the US. But it has now come to finally at the stage where there are enough interesting companies maturing in a private equity portfolio. And previously, these companies would have been sold unknown to the rest of us in the US and Europe in domestic deal, because there are quite a lot of Western private equity funds are now present in Japan, in Tokyo, but they are run by Japanese professionals, and you can sort of call it a cross-border deal in the sense that US PE or European PE funds are buying or selling from and to Japanese companies, but it's a domestic deal. Those are now becoming more globalized because the exits that we have been seeing in the last 24 months, and certainly will continue to see for the next 2-3 years, are much bigger, globally relevant, high quality assets, and those are coming out to the market as global auction. That's what we're seeing. The notable pickup of private equity activity in Japan for the last 3 years, probably more so than anywhere else, which is why all of the big firms in the US, in Europe, are busy setting up shops in Tokyo as we speak.
So across the globe, do you expect to see more cross-border activity into Japan perhaps, but even into other regions?
Yes. So speaking about the Japan in particular, Japan has been an outlier in terms of M&A activity. So obviously, I'm based out here in Europe, and see and feel and interact with European buyers and sellers. Whereas everywhere else in the world has been a negative growth in terms of M&A since last year to this year, Japan has still continued to grow. It's grown by 4%. Previous year, higher than that. If you look at it directionally over the last 30 years, that's how long as I've been practicing M&A based in Europe, it has seen 144 times growth in terms of outbound M&A activity from Japan into Europe, for example. But at the same time, Japanese corporates are selling 5 times as many assets that they own, non-core asset disposal, over the last 4 or 5 years. There are many, many different reasons for that, which I'm happy to go in as we sort of look for the commonalities and differences with the other regions. But yes, that trend will definitely continue will definitely continue going ahead.
Richard, how about the UK? We've certainly had a number of North American suitors come in and target UK PLC. Do you expect that to be a trend going forward, a lot more inbound cross-border activity into the UK?
Yeah, I think definitely, because there is I was going to say it's a perception, but it's a reality that businesses in the UK on the UK stock market are cheaper than businesses in the equivalent businesses in the US. And therefore that is a very appealing prospect. I think the important thing is, and in most cases, the businesses that are being acquired have a very international outlook. And therefore they are not a proxy for the UK economy. They're actually businesses that have far greater opportunities for growth than the UK economy does. And that dynamic, so an international business at a relatively lowly valuation listed in London is certainly appealing to international equity.
And I guess that's going to be helped to an extent with the sterling now trading at near all-time lows.
Exactly. I mean, I don't think it's all-time lows. I
Yeah.
remember
Yeah.
that, but no, but certainly the direction of travel is helpful. I mean, I do think, U.S. private equity, as they have been looking for opportunity, have been imaginative and been looking more broadly than the shores of the US. I think actually now with some of the growth and some of the enthusiasm that we're seeing in the US, the international tap may be turned slightly off or less, be less prominent because there'll be deals to be done in the US.
Bill, you mentioned the new administration or the incoming administration earlier on in the conversation. Is there a so-called Trump trade at all in the M&A market?
Well, that's a very interesting question as well. And it's been a very interesting last 5 or 6 months, and I'll try to get to your question. When just before the election occurred, there was what I would almost describe as an air pocket of uncertainty in the U.S., where people were buyers and sellers were very cautious about transacting until they knew the outcome of the election. The outcome of the election occurs, and President-elect Trump obviously won, and we saw a rise in valuations in the U.S. I think on the optimism of his platform that he ran on as being very, very pro-business. By law in the U.S. Constitution, the new president-elect takes the oath of office on January 20th after an election, and that will obviously be next week. It's been reported in the press that the new administration under President-elect Trump is working on a large bill to encompass one bill, which would encompass a lot of the economic and political policies that he ran on. And I think there will be a strong effort made, is my suspicion, and again, this has been reported to a degree in the press, that very early on after his inauguration, he will work with the new Congress to put a bill through which will bring into law a number of his policies, whether it be tax cuts, whether it be immigration reform or other significant policies that he ran on. And I think that's an interesting dynamic to watch in terms of a potential catalyst. He will have control of both houses of the U.S. Congress for at least the next couple of years. And if that bill, he's got a very thin margin of control in those houses, but if he and his administration are able to pass that law to bring into law a number of his economic policies, I really do think that could be a catalyst for any remaining uncertainty. And uncertainty always exists.
Tariff thing is the big question for people, and whether that's an inflationary driver as well as being a restraint on export for the EU and the UK. So I do think some clarity on that would be helpful, because clarity is always helpful. But I think the persistence of inflationary dynamics, again, we've got them in the UK as a consequence of the budget, is a big concern.
Do you see these potential tariffs driving M&A or consolidation? Are your clients worried about it? Your clients in Europe and Asia particularly?
Yes. I mean, in the UK, most of our exports to the US are services, which is helpful. Obviously, in Germany, with the automotive industry, it's a big concern. And so I just think people are very anxious.
Yeah.
It's a difficult one to read because, of course, and you can't base this on what's happened recently to Nippon Steel, etc., because that one Republican blocked it, but Democrats were also saying pre-election that they weren't for it. The job protection in US is more an important election issue than that. But overall, so there's going to be a higher tariff, which should encourage some inbound M&A in order to allow distribution and production to happen in the US. And that's very important for Asian manufacturers. On the other hand, there's a protectionism. So, big loser might be a Chinese electric maker. If you look at it, they are highly price competitive. They are being super, successful across Europe, across UK. In some countries like UK, we don't have, extra Chinese tariff on top. In Europe, despite the tariff, it's still being extremely successful. It's even being successful in Japan. The Chinese electric vehicle is being surprisingly successful in Japan. So how does Trump government going to react on that? And of course, you do too many sort of tariff and protectionism, that's going to hit a cost of goods in the US, which is going to hit the pockets of ordinary US people. Again, also on M&A, more liberalized, relaxed merger control framework should help some of those bigger deals and acquisitions to happen. But that's separate from sort of protectionist attitude, which will apply to certain industries in the US.
So in short, we're all confused, and we hope to get.
It's a hard one to read.
Yeah.
Yeah. Tosh, you mentioned China there briefly, and tariffs aside, China has been a relative laggard over the past year, in Asia certainly, but also globally. Do you see activity normalizing there anytime soon?
Yes, especially the drivers around private equity and the financial investors. So if you look back, so we've been tracking and participating in China to West cross-border M&A for many years. In fact, even today, 20 to 25% of all Asia cross-border deals we do are China inbound and outbound. But the nature of it has changed very much. So if you rewind back 10 years, there were some random speculative investment, right? Like a real estate company is buying a gaming company abroad, etc. Chinese government came in, cracked down, set the rule, and then strategic industry only. And then American in the Trump version 1 reacted against it. Germany eventually reacted against it, and so forth and so forth. So it's become a very heavy sort of headwind against the Chinese outbound acquirers. But then what's happened then during that time is that the Chinese financial investment community, the Chinese private equity, has evolved and become very, very sophisticated. So these days, many of those leading Chinese private equities have offshore money outside China, US dollar accounts, hire very sophisticated investors and M&A advisors who are quite often local and Western. And they have either a fund structure which are very, very clean at all the way down to their LP levels, or they have a mainland sort of China fund, but they go into joint venture fund with Western LPs and create a very specific China-West cross-border vehicle. And they often co-invest with their main mothership fund when the situation allows. So there's been a lot of sophistication and evolution on the Chinese investor side, especially in areas like healthcare and high tech, where they are not blocked by the national government. So, and we are seeing this, and we are finding ways and M&A players from China to do Western deals even today.
Do you see them, Richard, deploying more into Europe perhaps, and UK in particular, as relations with the US grow more strained?
Yes, I mean, I think the UK is trying to be friends with everybody. Given that we seem to have little or no growth of our own, we'd like people to come and invest here. So I do think the advantage we have, and it is one of a very small number of advantages of being outside the EU, is that we can play a different game on these global strategic relationships. The problem we have is that we're so small and so irrelevant that it's not clear that the US or China really care very much about talking to us. Because again, to announce 600 million over 5 years, which is what Rachel Reeves just did, is pathetic.
Yeah. Yeah. Could the London Stock Exchange perhaps be a winner? Uh, could we see London host the likes of Shein or other large Chinese conglomerates that are perhaps not welcome in New York anymore?
Yes, I do, and I think that's. But it will be interesting to see whether they become more welcome in the US, because I do think it's a very fluid situation, and you have a very fluid president-elect.
Yeah, because it's not. I don't think Trump 2.0 is against all things Chinese by any means. And again, just looking at China, China M&A version 1, once upon a time, was to find a great Western brand and Western ideas, bring it back to China, and use the fertile Chinese market to invent and create an operation 10 times the size, 100 times the size of the seeds which they harvest outside China. That will continue, but more in the areas of sort of high brand, high fashion brand, and things like that. Coming into the West, they will reverse export some of those things which they have developed in China, including some areas from technology and IT service, etc., where it does not infringe upon the national security topic of US and Europe. So in the question that you asked on sort of very popular Chinese brand IPOing in the Western market, I do see that to be quite feasible or even welcome or even very popular. The private equity also is very important. You see, I would be very careful in saying this in front of two chief executives or executive chairman and a chief executive. But if you talk to headhunters, the gig is either in Western private equity operating in Tokyo. That's basically apparently the most in demand. And another is Western educated or Western trained M&A or private equity guy working for a Chinese private equity in London. Seems to be another big gig happening right now.
Okay, yeah. Globally speaking, are there any standout sectors for you? Do you expect to see sort of more active sectors in 2025?
So the sector that actually has suffered the most has been technology. And I think it suffered the most because what goes up, and it really went up, probably does have to come down at some point. And the range of potential valuations in that sector has been so vast that people are very, very reluctant to try and pin it through a transaction. However, there is a huge amount of opportunity in that market. And as things stabilize and become less volatile, I think it's inevitable that technology will be a major driver, as I think will healthcare.
And within technology, how big will AI be a driver? We're seeing quite an AI craze here in public markets. Do you expect that to translate into more M&A activity, perhaps?
Perhaps. I mean, I think it's easier for public markets to bet on AI than it is for private investors, because essentially you can make a decision that you're in and then you're out if valuations become very volatile. Picking winners is really, really hard. And so if you as a private equity firm are going to stake your reputation on your ability to pick a winner in such a volatile market, I think that's bold. And so I do think the public markets are probably easier for AI. And then we will see large corporates buying what they perceive to be the best so that they can take it and integrate it into their existing proposition. That will inevitably be a major trend.
Bill, the US perhaps is now seen as the global leader in AI. Are you seeing AI impact the M&A process itself in the US perhaps first before anywhere else?
Well, I guess on two levels. Number one, from a transaction standpoint, everybody is interested in AI. It is an area where, our technology team is spending a lot of time and having a lot of dialogue. And it's really important to our technology business, not only in the US, but globally. But if your question also relates to the M&A process and the profession of M&A, it has not begun to impact it significantly yet. I would offer, but I think it will begin to impact it more and more as we go. And I think we could see some of those changes, in the shorter term. And I am not an expert on all things AI. I defer to the members of our technology team. But I have, if you, as a firm, we are looking at AI tools, and it's really been, I guess, a combination of shock and one of being very impressed. If you go to any number of language models, whether they're targeted language models or large language models for artificial intelligence, and you ask basic questions that might be related to investment banking subjects, whether it's tell me about the top trends in healthcare today, or what valuation techniques are most important and relevant to a specific sector. What you get in a very short period of time is really quite shocking in terms of its relevance, its sharpness, the facts that it draws on. Now, there's still plenty of room to, as you look at those, assess that there are errors in some of that material, but it could get you far along quickly versus a lot of the homework that we all have traditionally done. And I would imagine that while that pace will continue to accelerate, so it may have more of an impact, I do think it will be hard to replace, good old-fashioned human judgment completely. So it's something that we're beginning to see impact our business more and more, and we're watching it very, very carefully.
Just conscious of time, so want to circle back to where we started the conversation. If we don't see M&A activity pick up meaningfully until 2026, does it mean we're going to end up with a massive deal backlog going into next year?
Yeah, so Sveta, if you look at what we think is going to happen, it's like a layer cake, really, because at the bottom of the layer cake, you have got private equity that has to transact. They have to start selling businesses. And if they're going to be selling businesses, someone will buy them, probably for a lower valuation than they thought. So quite apart from which market you're in, that's a major driver. You've then got of increased activity. You've then got positive drivers in Japan, where the increased focus on shareholder value and realizations will drive private equity into the market and create significant amounts of opportunity there. You've then got the next positive, which is the US, where there is inevitably a pro-US, pro-business agenda that will be legislated into our lives. And therefore, it feels, again, inevitable that there will be more M&A. So the question as to whether it's the end of 25 or the beginning of 26, I'm not sure about. So essentially, we've got these existential drivers that will almost inevitably mean that by the end of 2025, we're really busy. Whether the transaction lands in 2025 or into 2026 is, frankly, anybody's guess. But by then, the flywheel will be rolling, the momentum will be there, and we'll be looking forward to a much improved M&A story, although we will be tired.
It sounds like we're all in for a very interesting 2025 then.
So as we are. So thank you very much for hosting us on this conversation. I do think we are in for a very interesting ride. And I am pleased to say that I think it's a market where the value of good advice will be higher than ever before. And so I'm delighted that we have what we have to offer to our clients.